First, our top story in the BNN Bloomberg newsroom is the Consumer Price Index. We got a fresh read of inflation in this country, and it re-accelerated more than expecting. At a headline reading of 3.3%, that was above what economists were forecasting. And when you look at the details, it was broad-based, but almost exclusively driven by one component. That is the rise in mortgage interest, I should say, rising by a stunning more than 30% at a record pace. Of course, a lot of this has been driven by the Bank of Canada's own actions. Doug Porter is the chief economist at BMO Capital Markets. He called this report not great for the Bank of Canada. Doug, thank you so much for being with us. I'd like to start, if I could, with this mortgage component part, because I think this is something that everyday Canadians might struggle with. Why is the Bank of Canada raising rates to deal with inflation if their rate increases are the key component driving up inflation?
Yeah, and that's always a challenge. So one thing I would point out right off the bat is it doesn't have a large weight in the index. It's actually less than 4% of the index. But of course, when you rise by 30% in a year, that's going to add more than a percentage point to the overall inflation rate. So, many have pointed to the calculation. If you strip out mortgage costs alone, look, inflation is close to 2%. Like, what's the issue here? I guess what I would say is imagine where we would be had the Bank of Canada not raised interest rates over the last 18 months. For instance, also buried in the report, we actually see new home prices down from a year ago. Things like furniture and appliance prices are actually down a bit. So clearly the interest rate hikes have really squelched demand, especially for big ticket items. And so that's reduced the prices, or at least calmed inflation in a lot of other areas. So it's really not a straightforward calculation. You can't just take mortgage interest costs and say this is what inflation would have done had the Bank of Canada not raised interest rates, because all kinds of different areas would have seen much stronger price increases than what we're seeing today. And I guess the final point I would make there is, we also saw some the home sales data today for July, and it showed a little bit of a retracement, some cooling off in the housing market. And again, that's entirely due to the latest increases by the Bank of Canada, calming demand in other areas.
And that's good perspective on what's gone on over the past year. I guess this brings me to my next question is, what does this data point tell us about what's going to happen in the future with respect to the Bank of Canada and its rate increases? The market pricing in a little bit higher odds of a rate hike in September, though that's far from kind of the base case right now. How are you thinking about how the rate environment is going to evolve from here?
So I have to tell you, I probably came into today thinking that there was very little chance that the Bank of Canada was going to raise interest rates in September. And the main thing I would point to is we've seen 3 months in a row where the unemployment rate has risen. It's now up by 0.5 percentage point just since the spring. That's quite meaningful. And there are other areas that are suggesting that growth is cooling. We're seeing slower spending almost certainly across the board. This does throw a little bit of a curveball into the calculation. The last I looked, the market had about a 30% chance of a rate hike in September. I think that's about right. I do still view it as less than 50-50, but there is going to be a real debate in a couple weeks at the Bank of Canada. We have one more key piece of data before that meeting. We actually get the full second quarter GDP numbers at the start of September 1st. And I think ultimately that might be the deciding point for the Bank of Canada. But at this stage, I would still lean to the view that the bank's probably going to move to the sidelines here and give it a little bit more time. I mean, they did just hike again by 50 basis points over the summer. So I think it actually does make sense to stand aside and see whether this is just a 1 month flash in the pan. I guess the last thing I would say is, even though the headline number was bad news, no two ways about it, the core measures actually were mostly in line with what we in the market expected. And we are seeing a little bit of moderation in most of the core measures. And I think that will give the Bank of Canada just enough comfort to stand aside for now.
I think that's important to mention the core numbers. I want to pick up on a point that you mentioned about what's going on in the job market and the fact that we have seen these months of consecutive deterioration that some economists view as an early indicator of a recession. I mean, at some part of this year, we were celebrating the fact that inflation was coming down as the job market was holding in. Could we be in for a scenario where inflation is still a problem as the job market starts to deteriorate? I mean, that's kind of the worst case scenario for Canadians.
Unfortunately, I think that's exactly what we're looking at over the next few months or so. And, on the inflation front, we really are in the so-called last mile issue here. So in other words, it was easy to get from 8% to 3%. We just needed gasoline prices to stop going crazy and, some of the supply chain issues to work themselves out. But to get from this sort of 3 to 4% trend that most measures of inflation are now seemingly locked into, closer to the bank's 2%, I think that's going to take some time. It's going to take, frankly, a fair bit of softness in the economy before we really crack that inflation and get it closer to 2%. And yeah, probably will involve a little bit further backing up in the unemployment rate. So for a spell here, we could, as you say, be faced with, almost, at least temporarily, a worst case scenario where both inflation and unemployment are, seem to be edging higher over the next couple of months.
Canada is not an island. We are in a global market right now. And right now there's big fears about the slowdown that we're seeing in China. And you look at the market reaction, perhaps at first blush, thinking that whatever stimulus measures that China has put in place so far are not enough. What are you making of how this picture is going to evolve? And maybe we can use the bond market as an example. Why are we seeing these yields back up? Is it because of these concerns about inflation?
Yeah, I think it is. And first of all, big picture, of course, we've got to be concerned about a significant cool down in the Chinese economy. But I think it's important to point out that both Canada and the U.S. only have about 1% of their exports their exports to China account for about 1% of GDP. It's actually less in the U.S. Most of Canada's vulnerability to China would be on the commodity price front. And frankly, most commodity prices are hanging in there very well. Our single most important commodity, of course, is oil. Oil prices have actually strengthened in recent weeks. Food prices are still relatively strong. So we're really not seeing the strains in the commodity markets, not in a broad way from weakness in China. And that's really the channel through which a serious slowdown in China would affect Canada. It would be through the commodity price channel. And frankly, we're not really seeing it in terms of significant weakening in commodity prices. So while it is a concern, I don't think it's risen to the level yet that it's going to reverberate back onto the North American economies in a really serious way.